Welcome to Season 3 of Adapt, Climate Change and the Built Environment, where we interview professionals across the private and public sectors to discuss adapting the built environment to a changing climate. We believe that ensuring climate adaptation to extreme weather and evolving climate patterns needs us to re-examine what it takes to make our buildings, infrastructure, and communities resilient and adaptable so that our society can continue to thrive for years and decades to come. And with that, let's get started. Hi, Jessica.
Hey, Monika.
We are joined today by Carolyn Kousky. Carolyn Kousky is the acting chief economist at the Environmental Defense Fund. She's also the founder of Insurance for Good and an author of the book Understanding Disaster Insurance: New Tools for a More Resilient Future.
I actually have a personalized autographed version of that book. That's how big a fan I am of Carolyn's. We got to meet her, of course. I have to tell people, and I try to say this all the time, Monika, I mean, you and I talk a lot about insurance and what a big role insurance plays when we're talking about climate change and both the resilience of individual buildings as well as entire communities. And this conversation with Carolyn just proves how important it is. I mean, she's such an insurance expert. We actually could have talked to her for 3 or 4 hours. I definitely think she needs to come back at some point. But for people who think insurance is boring, insurance is not. And Carolyn really makes a point of how important insurance is to any individual, any business, or really any community, looking at how are we going to adapt to and be resilient to climate change as extreme weather gets worse, extreme heat gets worse, as our world sadly changes in ways that are not going to be easy for all of us to adapt to. So yeah, definitely do not tune out just because you hear the words insurance.
Absolutely. And this episode is really for everyone. We'll talk about the current status of insurance, what she believes is coming, and what tools we can implement to increase our resilience.
She is such a fantastic resource. Everybody needs to listen to her. Read her book too. Ooh, we'll put a link to her book, right?
Yes, we'll make sure we put a link to her book. So at this point, let's get to it. Okay, hi, Carolyn.
Hi, thanks so much for having me today.
It's an honor. You're currently splitting your time between 2 roles. Can you tell us about them?
I'm splitting my time right now between Environmental Defense Fund and a new nonprofit we just created called Insurance for Good. At EDF, I sit on our economics research team, and I also help oversee our insurance strategy. And I also help found Insurance for Good, which is an organization that was just started at the end of last year. And we help communities and the public sector with risk transfer solutions that can support their broader social and environmental goals.
We're going to have to dig into both of those. But before we do that, how did you end up here? What is your background?
Yeah, I've actually been thinking about insurance for almost 20 years, which is maybe a little scary.
No, I love it.
It actually all started when I was getting my PhD. And at that time, I was actually really interested in the benefits that people got from ecosystems called ecosystem services, and was thinking a lot about how we protect nature for these services that they provide. And that was when Hurricane Katrina hit New Orleans. I got pulled into an interesting project looking at the role of coastal wetlands in buffering storm surge. But in doing that, I started tracking what was going on with our recovery from Katrina, which you'll both remember was a bit of a mess, and also started to learn about the important role of insurance in recovery and our disaster aid programs. And so just got really interested in these bigger questions of risk management and how we manage natural disasters and extremes. And that kind of just kept spiraling there. I feel like it's like an onion issue, right? There's just more and more kind of questions and things to figure out. After I graduated, I spent almost 10 years at a think tank, an environmental economics think tank in DC, working on these topics. I then moved over to the business school at the University of Pennsylvania, where I ran a risk management center for a number of years, and then moved over to EDF and now Insurance for Good.
What was your PhD in?
It was in public policy, but it was a
Okay.
bit like a microeconomics degree. So I'm like a half economist.
Nice. And yes, we talk a lot about insurance, obviously, on this podcast and how a lot of times we can bash insurance for various reasons, but really in the climate change space, there are some insurers who are doing a lot of interesting things who are very into this.
It's interesting that you mention sort of people liking to bash insurance, which you hear a lot, particularly after disaster, so much frustration. And yet we have the really growing body of research on how important insurance is for recovery. And it's that tension that I find really interesting and problematic. And how do we start solving that? Because on the one hand, we know that people with insurance recover better, they recover faster. Our own research shows that they have fewer unmet needs in the short and longer run. The communities do better when more people have insurance. And all of that's really because it provides important dollars for the huge financial shock that it's a disaster. And often people don't have other good sources for those dollars. And so it should be, in some sense, seen as this really positive, important tool for recovery. And yet, when disasters happen, we hear so much frustration and difficulty with navigating that. And so one of the areas I'm really interested in is how do we develop insurance models that better help people so that they feel that they're beneficial to them as well?
Yeah, so those studies, it's funny you mentioned that about how communities do better when more people have insurance. I had never thought about insurance at the community level until I was talking to an engineer who was actually submitting a proposal to study. It was post one of the awful California wildfires, but from several years ago. So I don't know if it was like the Camp Fire or something. But he was explaining to me that one of the problems after a community is devastated by fire is that those people who do have insurance can often choose to pick up and leave. Whereas other people either don't have insurance or actually ironically, if it's the people who just like their houses somehow escaped harm, they might actually be stuck then in this community that basically people are fleeing from, and then you lose. And of course, most communities, they can't provide services unless they have enough of a property tax base and all that kind of thing. So yeah, how it's this really vicious cycle, how which people after even again, and the physical devastation of going through a wildfire or something like that is awful. But still, if you have insurance, you have the choice of, yeah, whether you stay there or leave. Whereas other people, either because they don't have insurance or they didn't get actually harmed enough to be able to pick up and leave, can be left behind in a community that really is no longer functioning,
Yeah,
right?
yeah, there's so many sort of complicated dynamics and scales that you have to nest together when thinking through both preparedness and recovery. And insurance is often discussed just in the role with the individual because it's an individual contract, and but clearly all the decisions of the individuals make up what happens with a community. And so you raise a number of really interesting dynamics that we see. One is related to, we see if you have insurance, you have a lot more options. That's definitely true. And in the state of California in particular, it's state law that you are entitled to take every last dollar of insurance claim that's owed to you and rebuild somewhere else or move somewhere else. And so that does open up options, but it also raises questions about that community that you're leaving, its continued viability. We know after some big disasters, communities see population declines for quite some time. On the other hand, it also creates opportunities we've seen for developers to swoop in, and we might not be changing overall societal risk levels when that happens, even if individuals are. And that raises a lot of interesting and problematic equity questions too, right? Because often uninsured households tend to also be of lower income and so have less other financial resources to draw on as well. And so there's some sociology work that really shows that if you have insurance, you can get back on your feet, and people without insurance can actually spiral down into even worse financial conditions. And so lack of insurance can actually widen income inequality after a disaster. And I think you could see that at a community level as well. And maybe the last thing, you put so many interesting issues on the table, but maybe one quick other thing to comment is that I'm also beginning to really believe that the period of recovery is just so challenging for households and communities. And there's so much, and it's so fraught and difficult. And yet it's also our one opportunity to think about building for our climate future again. But it's really hard to have the plans and the mental space and the capacity to do that better rebuilding if you haven't thought about it ahead of time. And so how can we get more households and communities thinking about what does our climate future look like, and how should that change the way my house is built, the way my community is structured, or where I'm even living? And those are really hard questions, as you both know.
All right, and I'm sorry to keep beating this dead horse, but I do just have to say one more thing on this. Talking about the inequities and developers swooping in, I know that's been a big conversation post the Maui wildfires in particular, right? I think every billionaire and multimillionaire is trying to build some compound in Hawaii for a lot of those communities. And I don't know if they were insured or not, but I know they've certainly talked about because of the devastation, they are more vulnerable. And so developers are like, hey, let us buy up this whole area. The community, the tax base may actually increase. Some of the mayors of these towns may not be as concerned, but it basically will drive and destroy communities that have been there for generations. Whereas maybe insurance, if there had been enough insurance, that might have been prevented.
Carolyn, does insurance for good tie into all these needs for insurance for community and homeowners?
So we're interested in the intersection of insurance with four big kind of societal level goals. One is, as we've been starting to talk about, how do we build more resilience? How do we invest more in risk reduction? How do we do the climate adaptation work we need? So that's one. A second one, which we've also started talking about, is how do we have more equitable recoveries? And the other two themes that we focus on are decarbonization and the energy transition and a more nature positive world. And so how do we elevate nature approaches throughout the economy? So those are the kind of four big themes, and we think about where insurance intersects with them. But we do four buckets of activity as well. So we curate trusted resources for our growing community of practice. There's a lot of noise in this space, and we've heard that it's really helpful to have a source that can be like, these are trustworthy things, or if you're only going to read one thing today, focus on this. We do a lot of education and capacity building with different stakeholders as insurance markets become stressed. There's a lot of new stakeholders to this conversation, and we found that it's really difficult to get to solutions if you don't understand the dynamics of insurance markets, which can be quite different from other types of topics and markets that these stakeholders have engaged in before. And then we have something we call our solutions catalyst, where we work closely with a partner on innovative approaches or solutions. So for example, we're working with the city of Philadelphia right now on a concept of parametric microinsurance around flooding. We're doing some work around how you rebuild more resiliently around wildfire. And then the final thing is policy and regulatory reform, because if we don't have the right institutional structures, it's really hard to make insurance the force for good that we want it to be.
And so how does that, I guess, because that came out of your work with the EDF, right?
Yeah, and we're partnering on several of these topics together.
So are there other organizations who are really involved with Insurance for Good besides EDF, or is it more just individuals?
We have different partnerships with different groups on particular activities. So
Yeah.
we're working with different partners in California and around wildfire and in our Mid-Atlantic work. So it really varies based on the project and the activities. Yeah. But clearly these are big problems and they require a coalition to solve them.
That's why I was curious. Are any of the big home, again, I was in Texas during the whole like black mold initial scare and State Farm tried to leave. At least in my awareness, that was a whole big first state versus and homeowners insurance kind of battle. And so I was just wondering, are any of them involved with this at all? Or are they all like, you guys do your own thing?
I think we have good relationships with a wide number of groups. I think a lot of the insurance issues require striking a balance between what is going to create a robust, healthy private market, what we need to protect consumers and make sure we have really good consumer protections in place, and then what we need around innovation to really start to use these tools to align more with our social and environmental goals. And I like to think that we try to find the kind of sweet spot among those different groups. It varies a lot state to state because insurance is regulated at a state level. And so each state has their own unique political dynamics, regulatory history, interests and concerns, different levels of hazard risk. So things can vary around the country. But as we've seen recently, growing insurance prices, which is partly due to climate and partly due to a bunch of other factors, many macroeconomic factors, is creating stress in these markets actually almost uniformly around the country. So we're seeing some of the similar issues start to play out everywhere and not just in the hotspots of like hurricane or fire risk. Indeed, insurers are seeing escalating losses from just bad storms like hail, severe convective storms, tornadoes. All of this is changing through like the middle of the country, those areas are also facing insurance stress. And so it's not just Florida and California and Louisiana as it might appear sometimes.
Yeah, so can you dig into that a little bit deeper and tell us what is going on right now with home insurance? What are the main challenges right now?
Yeah, so I think over the last maybe 5 years, one of the biggest thing is just growing prices, and that's been a nationwide challenge. They're higher in areas of higher weather-related extreme event risk. So, Florida has the highest insurance prices. That's not surprising, but they've been going up everywhere. And part of it is, as we talked about, changing extreme events, which are just getting worse year on year from climate change. But we've also seen challenges. Our prior period of high inflation meant and supply chain disruptions and labor market disruptions from COVID, that kind of those factors together made rebuilding a structure much more expensive than it used to be. And if it's much more expensive to rebuild, that means claims payments are higher. That means insurers have to charge more because they're paying out more. And so that led to growing prices everywhere. In individual states, you might also see different dynamics influence pricing around the legal environment or the regulatory environment. And also things like the tariffs right now have been a big conversation in the insurance industry, because if the tariffs make it much more expensive to rebuild or replace things, again, that's going to drive up insurance costs. So there's lots of dynamics that are not climate, but then you add the climate stress and it can really be a problem. So that was one, increasing prices. We've also seen more localized problems around insolvency. So after some big hurricanes, we've seen insurers literally become insolvent in Louisiana and Florida. That creates challenges for the state, because then all those claims have to be picked up by the state guarantee funds. We've seen a lot of growing concern about decreasing availability. So that could be insurers pulling out of markets entirely. Like we've seen insurers pull back from a lot of the high wildfire risk areas in California. The big name insurers largely left Florida years ago. They've been pulling out of Louisiana. But in addition to just exiting either entire states or more narrow geographies that are high risk, we've also seen increasing concerns from policyholders that their coverage is not as good as it used to be. So much higher deductibles, lower coverage limits, and lots of things in the fine print. And this kind of is where we start to meet some of those consumer protection issues of things like sublimits, which means you might insure your home to full replacement cost value. Like it's going to cost $300,000 to rebuild my home. But then it turns out, oh, but if the damage was hail on your roof, you're only getting 10,000, even if it costs you twice that. Or this was an issue after the ice storm in Texas. You could have burst pipes, and it turns out that's only going to give you 5, even if it's costing you 20 to repair. And so those hidden sublimits, often policyholders don't know about them until they go to rebuild. And then it's, oh no, I don't have the dollars I thought I was going to. Yeah, so a whole kind of group of issues here that are causing challenges recently.
That's so interesting. So higher insurance prices, less availability of insurance, higher premiums, less coverage, and read the fine print.
Read the fine print.
Do you see this going that same direction? Where do you see home insurance and challenges associated with it going?
Yeah, I think we need to have some serious conversations about the role of our state insurance programs, because when you can't find insurance or it gets more expensive in the private market, people move into publicly created programs. And we need to think about some of these consumer issues and transparency in the policy terms and all of that. And I think that's important. But very fundamentally, we are not going to fix insurance unless we dramatically reduce risk. And so I think the most important thing to focus on is how do we actually build safer communities in the face of ever escalating climate risk. And until we do that, we are not going to make insurance a kind of stable product anymore. So that's why we've been focusing, and I've been focusing a lot more on like where those intersections are. How can insurance help drive more resilience and risk reduction? How can we make sure that's showing up in the markets? How can we make sure people understand the kind of interactions between insurability and risk levels and housing affordability? So that whole constellation.
So this makes me think of what just happened in California with the wildfires in LA and rebuilding. And there was some stalling on building codes because they included some resilience, but because of that, the cost of that resilient home would be higher than a previous code. Do you have any thoughts on that?
Yeah, it's actually an issue that I've been thinking a lot about in the California context. I'm glad you mentioned it. You often hear this narrative in a lot of communities, and we've heard it in California after the fires, that stronger building codes are problematic because they slow rebuilding and they're more expensive. Insurance for Good partnered with Headwaters Economics recently. They're an amazing wildfire think tank group, and looked at the costs and benefits of building wildfire resistant homes. And the first thing to note, which is probably not surprising to your listeners, is that building safer homes saves way more in avoided losses than it costs to do it. The savings are just huge, not just to the household, but also to the community, right? Because you minimize all those other costs as well. So that's the first thing. But to your point about the building codes, what we saw in California, which I found really interesting, was that the state has a mandate that if you have good homeowners coverage, and by good, I mean you have replacement cost coverage for your dwelling. So that means you're going to get the amount you need to rebuild your home. Your insurance company is required by state law to give you an additional 10% of that amount to comply with new building codes. And what Headwaters Economics found was that the cost to take just a standard home and make it comply with California's wildfire code, Chapter 7A, which is actually really good, is under 10%. So if you're insured and you're jurisdiction has adopted the strong fire code, you have enough money. You don't, it frees up dollars for you. It doesn't cost you anything else. And that's, I think, a really powerful tool. The building code and the code upgrade coverage together unlock dollars for people to move into safer homes and to rebuild more resiliently. And then we looked at the cost of going to what I think is largely considered to be the gold standard in wildfire resistant construction, which is from the Institute of Business and Home Safety. They have a wildfire prepared home standard, and it's just a little bit more to get. It's 5K more on, we're talking median home values here of $1 million. So it's really small to go to that highest level. And that becomes really important because we're seeing that a lot of insurers are embracing the IBHS standard because it's comprehensive and you get an independent evaluation. So the insurer knows the work's been done. And so that is making them more likely to provide coverage at all or to lower your rates. And insurability in these areas is a huge issue that I think needs to be considered during reconstruction. And so if you can get to this standard, then you're doing the best thing you can to guarantee long-term insurability. And long-term insurance is absolutely critical to long-term affordability, because if you can't get insurance or it's really expensive, even if you've saved money on the upfront construction over the life in the building, you haven't helped the affordability. So yeah, lots of really interesting dynamics and interactions there between building codes and insurance and affordability.
Okay, there's still so much. It's hard not to just jump all over because everything you say brings up like multiple new fascinating issues. But I want to just address that point about the affordability thing. I know one thing I've been seeing in the past year, especially it's usually focused on Florida or some places, North Carolina, right? And rich people keep rebuilding. And so I've seen discussions about again, this kind of goes back to the Maui idea, but a little bit different twist on it, that in some of these areas, rich people will continue to rebuild. If you're a multimillionaire, a billionaire, you can rebuild the same mansion multiple times without putting a dent in your income at all. So that's number one, that we're going to start seeing possibly that kind of idea, that they'll say, you know what, we don't need insurance at all. Or I've also seen now, and I haven't dived into it yet the way I wanted to, but this whole idea of admitted versus non-admitted insurers. I know from our horrific lawsuit many years ago that basically, if any of you ever want to jump out of a plane, just know that private company that you are flying with has literally no insurance. So if something, God forbid, horrible were to happened in a lawsuit I was briefly involved with years ago, like there's no insurance you're going to get for being injured or somebody dying or anything. And that's what this non-admitted insurance is. It's basically insurance for people who can't get any other insurance. Could you touch briefly on what's admitted versus non-admitted insurance? And are you seeing this non-admitted insurance angle becoming a thing where some homeowners are having to get that because they don't have other options?
Yeah, great question. And this just kind of highlights, right, as this kind of insurance crisis unfolds, how in the weeds you need to get to really start to unpack how we see our way out of it. So that's, yeah, one of the things we're trying to do with Insurance for Good. In any state, there's these two groups of insurers, the admitted insurers, like you talked about, and the surplus lines, non-admitted E&S insurers. Admitted insurers are regulated more heavily by the state. They have to have their rates and forms approved by the insurance commissioner. But then they're backed by state guarantee funds, which means if you're with an admitted insurer, and the big household names are going to be admitted insurers, if that company were to actually become insolvent, the state will still pay your claim for you. So it might be harder and more time consuming, but you are going to get your claim payment. It's like this kind of trade-off, like they regulate them more heavily because they're going to be the state's going to be on the hook. And so that's where most people for a long time have found their coverage. The surplus lines market is out there, it's less regulated, and it is not backed by state guarantee funds. And it's been out there for like much higher risk things that need to be insured, or more niche markets, or stranger, more complex and difficult risk. And so it was something that a general household probably wouldn't interact with. And that, to your point, is starting to change as admitted insurers are really pulling back around some catastrophe risks. We're seeing surplus lines insurers offer coverage. So they might offer wildfire coverage in California, or homeowners or wind coverage in a place like Florida. It tends to be much more expensive and is therefore, to your point, an option for much more affluent individuals to find the coverage they need and not have to go into the state pools, whether that's the California Fair Plan or Florida Citizens. But people need to be aware that what they're doing when they take on that risk is that they're not backed. And so you need to do a little bit more due diligence that they're a company that you think is going to be able to continue to pay out in a strong event. And many of them are. Many of them are backed by places like Lloyd's and are very financially sound, but you have to take that due diligence on yourself because the state isn't doing it for you. And yes, to your last point, I don't have the statistics in front of me, but I think in a lot of high risk areas, we're seeing increases in the number of residents who are finding their policy that way.
All right, that kind of segues in then to my next question, which is what do you see coming? We've already talked about, obviously, nobody knows day to day what's happening with tariffs. They're here, they're not. So that's tough. Supply chain disruptions. I like to talk about that. Yes, the COVID supply chain disruptions are hopefully behind us. Hopefully, we won't have another worldwide pandemic anytime soon. But climate change actually can create supply chain disruptions. What are the challenges? Do you see just a continuing increase in the same challenges you were already talking about for homeowners? At some point, do we reach kind of a crisis tipping point where, I don't know, either new issues arise or it just becomes far worse? What are you looking at when you look ahead?
Yeah, I think the answer to that just depends so critically on the choices we make today around adaptation and risk reduction. And to your point, I'm incredibly concerned that we've not really internalized how rapidly and how much risk is growing every year. And it is absolute climate. We haven't done enough decarbonization that we need to. And every year it's just going to get worse. There's not some new plateau. So we are locked into having to think about what it means to be in a world of increasing risk. And a lot of our institutions, and I think our mental models, are worlds of stationary risk. And it's really different to be thinking about a world of increasing risk. And I don't think we've quite done that. But unless we get a handle on that and what it means to build more resilient, not just homes, but economies and locations, we're going to be suffering lots of losses, just honestly, right? We're going to be facing lots of events that cause crisis. And I'm also concerned, not to be too down here, but like that we have these kind of growing climate risks at the same time that right now the current administration is creating a lot of unnecessary, in my mind, economic volatility, which will also impact these things, and has also canceled a lot of the tools that the federal government had been using to help lower and manage that risk. So we've now lost several grant programs that the federal government had been providing to states and local governments to do that work of risk reduction, to help lower the potential losses from these events that are getting worse. And we've also lost a lot of the risk assessment data and tools from places like NOAA and NASA that help us understand those risks and how they're changing. And that's making American communities less safe than they were. And so all of that makes me nervous and skeptical for what we're going to see. But the kind of hope and optimism is that if we can really focus on creating climate ready communities, and this doesn't take a lot of innovation. We know how to build safer communities. We know how to build the IBHS standards for wildfire and hurricane are a great example. We can build structures that can withstand some of these events. We understand how to use nature-based solutions and to change community design. So it's all very doable. It's about getting the collective will and using that to figure out the funding and the financing and the politics to make it possible. And that is the future I think we need to be on if we want to stabilize insurance markets and if we want to have thriving communities in the face of escalating risk.
Yeah, the collection of data alone, I don't think people understand. I say this all the time, like you can't deal with something, you can't improve something, you can't fight bad things if you don't actually know what you're fighting. The role that the federal government plays in just collecting that data, there may be private entities who are collecting a lot of that data, but they're only going to sell it, right? They're private most of the time, unless they're insurance for good. Most of the time, they're for-profit entities that to the extent they're collecting data, they're going to sell it to somebody. But yeah, there's no way communities, individuals, scientists, academics, researchers, or anything can really help analyze and help us prepare for the future if we don't know what's going on. And so I'm like, I get that it's not sexy. I get that it doesn't seem like any big deal. Who cares how much it's raining right now in Wisconsin? But without that, we are basically saying, okay, we're facing this massive, really extinction level kind of event here, and we're going to blindfold ourselves and not find out how bad it is.
That's
So sorry.
exactly right. I'm really worried about it too. And I think there's also, to your point about there are private sector data and tools available. One is the equity of who can afford it, but also I don't think there's enough appreciation that at least in the insurance industry, almost all of the models they use are built on federal data. And so it's
Wow.
not and can't be replaced, right? Like some of our observation data, some of our satellite data, that is all federal dollars, and they might build on top of it, but those are federal programs. And so if you take that away, you've actually also collapsed the private sector risk assessment tools as well. So it's very concerning.
Yeah, I share the same concerns. I know this is a tiny part that was removed from federal funding. The NOAA billion-dollar disaster maps are no longer being produced. And so the risk is not going anywhere. It will, to your point, if we don't continue building resilient homes and resilient buildings, the risk is just going to continue to grow. But something we can all do today is read your book. I want to learn more about understanding disaster insurance. You wrote this book a couple of years ago. Can you tell us more about it?
Yeah, sure. Thanks. I did. I wrote this book to summarize my thinking around insurance. And at the time that I was actually doing the writing, insurance still wasn't the hot topic that it is today. And I think I say in the beginning of it, lots of times people would ask me what I did and what I thought about. And when you say insurance, people, that was the end of the conversation. They weren't as interested in it. Historically, I think it's been a very boring thing to think about. It's been fun the last few years. That's changed. But I wanted to help explain why I thought insurance was so critical for our future and these kind of innovations and new ways of thinking about it that could really unlock it to be a more powerful force for helping us achieve some of these goals that we have to, whether it's the resilience and equity we've been talking about, or also helping us on the energy transition. So I was trying to make it in between a little bit of a primer textbook for understanding the sector and also a look at these new things that might be coming that we could try to build up and invest more in. So there's a few chapters in there that I think are just in there for students who really want to get in the weeds. And then there's some other chapters that are maybe more widely interesting.
And I think part of what it touches on, and by the way, I have to tell our listeners, I have an autographed copy because I got to meet Carolyn in person. Too often, all this stuff is virtual, but Monika and Carolyn and I all presented with some other folks. Was that last summer? I've literally lost track of time.
I think it was the summer before the
Oh
Columbia
my
University
God.
Managed Retreat Conference.
Yeah, it's a great
Right.
event.
Yeah, but I think part of what it really hit home for me, and so now I want to turn to this idea, is that we're so used to thinking, oh, if I get in a car accident, or if I break a leg, or if something happens to my home, insurance will cover those losses, which also I have to note, as you said, that's actually a position of privilege that I even just assume insurance will cover those. Not everyone has insurance. We get into the whole medical stuff, which is a whole nother level of tragedy. But anyway, so I have to remind myself sometimes that there's a lot of bad stuff, even in my very privileged world, where if I get harmed, unless I can sue somebody, which I'm a lawyer, so I could do, but a lot of times you can't sue somebody, like just bad things happen, and there is nobody. It's just like me and my nest egg, right? Are the only things that can deal with that. When it comes to insurance and climate change, I think we've already talked about some of the challenges and how we can't expect insurance to take care of everything. But are there like big holes that you see with like homeowners? And even communities thinking we've got insurance to take care of like wildfires or floods or whatever. Are there big holes that we can't expect insurance to fill every hole? But what are some of those big holes that people may not be aware of?
Yeah, that's a good question because insurance is really there, like you said, to be that financial safety net for people. There's really not other sources for that. If you're incredibly affluent, like you said, and you have a big nest egg or something, you can cover your losses yourself. Otherwise, maybe you can take out a loan. But we see that also we've looked at the first line of defense after disasters is a federal loan program. And as income goes down, loan denials go way up. And so actually a whole segment of the population is actually locked out of access to credit. And we could do maybe you already have a whole episode on federal aid, and it's just not designed to make individuals whole. They usually only get a few $1,000s.
I did not realize that. And I do think now we need to add that to the list. That is insane. And that's insane that the denials go home. But yes, thank you. If you know anyone, I think season 4, Monika, we need to find somebody to talk about federal aid. I think point.
So yeah, so insurance provides this really important safety net. And as climate risks, like we're talking about, are becoming more, as these events are becoming more frequent, the need for it is more important because more people are living through disaster. So we see that need. And exactly as you said, it's often lower income families that aren't insured and the troubling thing is that they're the ones who need it the most because they don't have these other sources. And so often the families that need it the most are the ones that don't have it. And I think that's raised this really important policy conversation of this moment, which is infusing a lot of the state level conversations about the insurance crisis and the state created programs, which is, do we view insurance as a product that's on the private market and it's subject to market forces? Or is insurance a right or a benefit that all our citizens deserve? And those are very different perspectives on what insurance is and suggest very different policy interventions. And I think people are really starting to realize the really important social protection it provides people as these risks go up.
And right now, and again, I'm not an insurance expert and I never really have dug into the whole like the flood insurance kind of thing. But is that one example of like in general, and I luckily live on top of a hill, I do not live in a floodplain, but like the idea is that there's homeowners insurance, but I think the general rule is practically no homeowners insurance will provide flood coverage. And so is it state or is it federal flood insurance programs? But I think the economics of them are all messed up. We should probably do a whole episode on flood insurance and flood zones and all of that kind of thing. That right now, that's one example, right? Of that is as a community or as a society, we have decided that flood risks are something for at least some people that we will offer something that is a little bit more of a public kind of good, like kind of an insurance, not quite a right, because I think people still have to pay for it, but it's heavily subsidized.
Yeah, as you said, standard homeowners insurance does not include flood. It hasn't for over 50 years. There might be some tiny exceptions, but in general. And you have to buy flood insurance through the government program, which is a federal program. It's housed in FEMA. Private insurers actually write the policies and process claims, but they don't hold the risk. The risk sits with FEMA. FEMA sets rates. And there's just been ongoing policy debate for decades about those rates and how they're set and how much we subsidize or don't subsidize and who gets those, right? Right now, they're using private sector models to help set the rates, and they're trying to align rates with risk. A number of the highest risk properties are on an increasing trajectory to come to what would be called full risk rates, but they're not there yet. And I will note that what's full risk rates on the trajectory is flood risk as of 5 years ago or whenever this thing started, not even reflecting the fact that flood risk is constantly changing. I don't think we're doing a good job actually across federal flood or across standard homeowners to talk to people about how if you are in an environment of increasing risk, you are going to see increasing premiums. That's baseline for you. You should be assuming that. And nobody's saying that, so people are shocked when they see the increasing premiums. So that's another kind of risk communication issue. But we're also seeing insurers start to not be interested in covering other catastrophic perils as they get worse. So in all the hurricane-prone states along the Gulf and Southeast, you have state-level programs, so not federal, but state-level programs. They tend to operate independently, but they're created through state legislation that provide wind coverage or full homeowners coverage. And then in California, their FAIR plan provides wildfire coverage. FAIR plans were actually started in response to a pullback of insurers from urban areas due to civil unrest and rioting and a history of redlining and a whole host of factors. But now they're taking on a lot of other risk like wildfire. So yes, you get this weird mashup of public and private providers.
You alluded a little bit to insurance looking at historical data. Do you see insurance companies looking at forward climate data and evaluating not just the next year, but also the next 5 and 10 years and coming up with their premiums based on that?
Yeah, so a couple things to say on that. The first is that to underwrite catastrophic risk, by which I'm going to include a lot of weather-related extreme event risk that's changing right now and might be low probability anyway, historical data is insufficient. So going back to the early 1990s, following some really big disasters like Hurricane Andrew that hit Florida in 1992, as well as the Northridge earthquake, which hit California in 1994, that kind of coincided with a rise in computing power and data availability to create what are called catastrophe models. And these are simulation-based models of natural hazards that kind of throw 10,000 hurricanes at Florida and get a kind of probability distribution. And they couple those to specifics on the building type to get to estimates of property damage, of loss that an insurer would need. So on the one hand, they are accounting for in these models like current conditions. But as you started to say, insurance prices for this year risk only because it's only a 1-year contract. And you wouldn't want them to be pricing for what the risk is going to be 20 years down the road because then you'd be paying a lot more. But because of that, it's also not a good information signal or financial incentive about what we need to be doing, given that risk is going to be higher and is not a good communication tool. And insurers, they don't want to be saying, hey, here's your premium, but guess what? We're going to be raising it all the time because your risks are going up. So consumers aren't getting that information or that signal. And when we invest in a house or a building or infrastructure, those are long-lived investments, and we need to be thinking about those with the risk in the future so that we're building safely for that future. And insurance isn't providing that information. And to come back to this like data question that we were just talking about, right? Communities need that when they're thinking about their building codes and all that kind of.
And again, it does tie into building codes. You're right. I've lived in the same house now for over a decade. So at the time I bought this, I certainly wasn't thinking about all of these issues. But I think most of us assume that there are building codes and community leaders and insurance, that everyone's looking at this. And this house wouldn't be here, or they wouldn't be renting me this apartment if it weren't safe, or that if it weren't going to be here for the long term. And I think, yeah, more and more, I'm appreciating that. I think a lot of us just assume a lot of things. Like you said, and Monica's talked about this too with the ostrich paradox, that we are good at thinking about known and static risk, right? I always say Minnesota and Wisconsin, we're prepared that we're going to have ice in the winter. So we think about those sort of things. But yes, a world of escalating risk, none of us are prepared for. But I think far too many of us assume that someone out there is thinking about these things and taking care of these things. And as we've been talking, I've just been thinking again, another guest we have to have on, and I think this is maybe the biggest hurdle, is how to communicate all these issues to people who don't have the privilege or the ability like we do to be thinking about these and talking about these things all the time. Which also leads me to another question I have, because I often like to say, being here in flyover country, the great state of Wisconsin, I find a lot of people, especially here in Madison, traditionally kind of liberal. So people have their solar panels, they're all go green. But I find a lot of people here, even those who are very like worried about climate change, are not necessarily thinking about it impacting us here. It's about the wildfires in California. It's about rising sea temperatures, glaciers melting, maybe the fact that it's going to get hotter here, and certainly has been. But I know we've talked a little bit, and we've talked about like the wind-driven rain, the convective storms. So how is it like people in the Midwest, we need to be worried about climate change and how it's impacting us here as well, especially tied into homeowners insurance?
Yeah, I think that's a great point. Yes, climate is impacting all sorts of weather-related events. It's impacting, like you said, storms, snowstorms, nor'easters, yeah, different temperatures, extremes on both ends, rain, hail, lightning. So it is not just a coast problem or a wildfire problem for sure. And I think I want to pick up on another thing you said, because I think it's also important, is that I think there's also maybe a misunderstanding that climate is just making things a bit worse where they were. So in a flood-prone area, it's like a little bit more flooding or whatever. But what I think is most concerning is where we're actually seeing such changes in risk that the types of hazards we're experiencing in geographies is actually shifting. I'm thinking about, was it last year or 2 years ago when Louisiana had wildfires and Southern California got a hurricane? And you're like, wait, no, Louisiana gets hurricanes and California. And so it's like perils that we're not accustomed to. And then also just entirely new risks that climate's going to bring. I think it was also a few years ago where salt water started intruding up, getting close to New Orleans. A colleague's doing some interesting research at Penn on saltwater intrusion into drinking water along our coastal communities, right? And that's a risk that I think is not really in many people's minds. And yet desalinizing water is extremely expensive and will have huge fiscal impacts for these communities and their costs and their viability. So there's also just totally new risks that are emerging. When you actually start to dig into the climate science, it can get pretty scary.
Yeah, I understand desalinating water is not just expensive, but also really energy intensive. So we have a lot to deal with ahead of us.
I was also
Yeah.
reading about, yes, somewhere, I can't remember if it was a community in Arizona or something, looking at doing some sort of desalination project to get water and actually doing the pipeline from the ocean through Mexico to Arizona. Another problem with desalination, it actually can screw up then the ocean water there too, then. That process actually can be very disruptive to coastal ecosystems, which are also already having major struggles. And as we have seen with storm protection, wave surge protection, things like that, right? Like we actually need those ecosystems on our shores. So it's a whole vicious escalating cycle.
To close the episode, do you have any advice for homeowners? What can they do or what should they be thinking about when it comes to insurance as the weather changes and more extreme natural events take place?
Yeah, it's a good question. I guess my advice is to be a little bit more proactive, especially at important decision points. So if you're deciding where to live, do your own research on what those risks are and how they might be changing and take that into account. And figure out if those risks match the types of risks that you want to take on, get quotes on your insurance before you're near closing on a property to understand how insurance pricing might impact your ability to afford a property. Look at the fine print of your insurance policies, ask for it, ask specifically about sublimits and deductibles, and just take more of that on. And in general, I think it's really unfair to ask consumers to have to do so much of this due diligence on their own. And so separately, we're pushing for some policy reforms that would help create baseline standards for insurance policies and make sure that communication about risks is really easy for potential buyers. But before we're there, I think people do need to take it on a little bit themselves. And then also at moments where if you're doing a renovation, that's a good time to incorporate resilience measures into your home. And there's a lot of good sources to help. Unfortunately, it takes some digging for people on their own, but things like IBHS have great information on how to build safer, and the benefits, really do outweigh the costs.
Thank you. I think this has been such an excellent conversation. You definitely have to come back because there's a million more things we want to talk to you about. We will definitely put in the insurance for good, your work with the EDF. I think obviously a link to your fabulous book, which I highly recommend to everyone, as well as some of those resiliency tools. Because you're right, Monika and I, part of what we're doing is not just trying to make people aware of these issues, but also at least the bright spot in all of this is there are a lot of resources now. And a lot of times when it comes to adaptation, there's simple things we can do. We actually talked to Ann Cope about that in our first season. So we can refer people back to, I think it's episode 8 of season 1 to talk about some of those.
I'm going to go back and listen to it too.
Yes. Okay. Yes, you should. Thank you so much for this. This was a fantastic conversation.
Thanks for having me on. It's been wonderful to speak with you both.
Thanks for listening to Adapt: Climate Change and the Built Environment. We hope you enjoyed this episode and come back to hear more of our conversations with people leading the way and addressing the issues facing the built environment as our climate changes. Please rate, review, and subscribe, and share our podcast with others who may be interested. And if you have any feedback or suggestions for topics or guests for future seasons, we'd love to hear from you. You can email us at adaptthebuiltenvironment@gmail.com. Thanks for listening.